Here to work through today's trade is Lincoln Ellis, Chief Investment Officer at Strategic Financial Group. And Lincoln, it's interesting. Today I was reading a lot of things that seem so positive. You know, they're worried about inflation globally, which I guess you could see as a positive.
Yeah, sure.
Davos is switching from crisis mode to learning how to deal with the economic super cycle that's going to propel growth for the next 2 generations. And even in Europe, people are no longer worried about the crisis there. They're taking off hedges against a declining euro.
So why are you worried?
Yeah, what keeps me up at night? I mean, look, we haven't been too worried because the liquidity on a global basis that continues to fuel all of these asset prices around the world. You've had the ECB say that they're going to backstop the euro currency, so that's chased people out of that trade. And really, you've seen a wholesale sort of risk move from the small caps and emerging markets into large caps and developed economies.
Let's head out to Chicago, bring in Matt Shapiro. He's president of MWS Capital. He's the Chicago Board Options Exchange. So, Matt, not too shabby. You know, we lost last week in terms of stocks overall, but looks like the rally trade is back on or not. What do you think?
Well, definitely back on. We got through that micro correction last week, and here we are with this quiet up move to 12,000. Doesn't seem like actually a lot of activity on the floor. The VIX trading pit is very quiet, and that's one of my big technical supports of this market is this quiet rally. It's very bullish. It means stock values are very solid here, and I think that's going to be self-fulfilling as companies can make projections about earnings and investments, and investors are going to have to get out of cash and bonds and get into this rally.
Lincoln, what do you think about that? I mean,
look, I'm not particularly sure that that actually is the case. In fact, it seems to us that retail investors and institutional investors have sort of stopped playing this game, and I think we were talking about this in the break, that the volumes continue to dry up, and that's actually what's drying up the volatility.
What volume?
Volatility, exactly. And so I don't think you will see individuals or institutions chase stock valuations here. I think the underlying fundamentals continue to be only liquidity driven and government backstopped, and that in fact we could, and we probably will, take out this 1% move to 1,300 on the S&P, and then we will start to reconcile what's actually going on in the global economy.
Hang on one second, because I do want to continue talking about that.
You know, and Lincoln, Adam makes a really good point. I mean, you look at these earnings, look at CSX. I mean, they move a lot of stuff around. They're a great indication of what's going on in the economy. So that's upbeat news from what we're getting from them. Then take the whole earnings picture in terms of the revenue numbers. A lot of folks are beating. You can't play around with that revenue numbers. Doesn't that make you even more upbeat about the outlook here? Things are getting better in terms of the corporate picture environment.
I think it reflects what we saw over the third and fourth quarters. We saw consumers save a bunch in the third quarter, and then we saw them go out and spend a bunch in the fourth quarter. And that drove rail traffic, it drove highway traffic, and of course it's going to drive revenues.
Why can't it continue? Why can't there be momentum going forward?
Because the U.S. consumer continues to be way over levered and undercapitalized, and it's just not sustainable. That's why.
So they're not just tapped out. They have too much debt, and they continue to have too much debt. I think the number is still like 122% to income.
And if I recall correctly, the unemployment rate is still north of 9. So.
Matt, we got a big pessimist on set with us. Help us out, because you seem much more upbeat there out in Chicago.
Yeah, I don't think Lincoln's looking at the big picture, which are these quiet rallies, is actually very bullish. Revenues and earnings are at all-time highs. There's another technical force, which is small and mid-cap stocks being a confirming factor at 2007 highs. And I think Lincoln needs to take a look at the long-term demographic factor, which are these baby boomers who are afraid to get into this market and actually, you know, citing many of the things Lincoln is talking about, but they're going to be living a lot longer, and they're going to have to get out of money markets and bonds and get into stocks to preserve their purchasing power.
What do you think, Lincoln? I mean,
Look, the rotation's already happened. The spread between large cap and small cap stocks in the U.S. came off almost 45 points in the last 10 days. The risk is moving out of the normal cyclical things that lead you out of recession. So that means you're up to a plateau level. And then the question becomes, as we were talking about before, as Carol was suggesting, is the recovery sustainable? And to what level is it sustainable? So if we get a 4% number on Friday, great. Will we get a 4% number in the first quarter of 2011? Probably not. And in the backside of 2011, are we going to print 4, 5, and 6 as we normally would out of that kind of cycle? No chance.
So how bad do you think it's going to get then? I mean, if you think it's going to continue
it's not about
deteriorating into 2011, unemployment then I would guess you think is going to go even higher.
No, it doesn't have to go higher. It simply doesn't come down in a normal post-recessionary period. So you could have 2.5% growth, very much Japanese-like, and you could continue to have 8.5%, 9% unemployment, and that is where the rub or the two roads don't meet.
Hey, Lincoln, it's Dominic here. You were on Bloomberg not too long ago talking about something called stag-in deflation. Now that's a horrible sounding term here, but is that what's providing like these headwinds that you're talking about here?
I think what we'll see in the second half of the year is exactly that. Stagnating pieces of the economy accompanied by inflating pieces of things that we need but don't actually own, like energy and food, and then deflating things like our wages, and that is the stag-in deflation, when all three of those things happen in an economy at the same time.
All right, I'm going to throw another bear at you, and I hate to support your argument, but I'm going to do it. Listen up, everybody. Bob Jandua of Nomura International. He's known as Britain's Uber bear. He sees U.S. stocks in a 10% correction. He told our Eric Schatzker why.
My biggest doubt is on the U.S. recovery, and I'm going to suggest that actually this year will end up like last year, where in Q2, Q3, and as the year unfolds, the growth story weakens. And then, much like last year, we're going to be looking for QE3.
All right, so he's pessimistic. Dom, I want to bring you into this because you're also looking at those bank valuations, and they kind of support no recovery for that group.
Well, bank stocks have been up about 165% since the lows back in March of 2009. But check this out, guys. If you look at what's happening here, they're still trading at about 12 times estimated earnings. So if you look at what's going on here, it really is the valuation is not expanding. If you look further beyond that, they're also kind of trading in terms of, banks, brokerages, everybody else there, about maybe just about 1.2 times book values here, okay? Book values being assets minus liabilities. And Goldman Sachs, JP Morgan, Bank of America, they're all some of the cheapest stocks in the S&P 500 with regard to price to earnings valuation. So, Carol, it's one of those situations where, financials may be going up in value, but nobody's paying a premium to own them right now, Carol.
Matt, so take that into account. What's going on with financials? We just heard from Bob Jandua about his outlook. He's expecting QE3. Doesn't any of that make you a little bit nervous about what we could see this year?
Well, I think JP Morgan, I'd like to see at $45. And for me, that's a recovery. Can I get it to 50? I don't know. I think that's going to be tough. I think the financials are going to be tough to make money. But what I like are some of the other market leaders, such as rails, coal, iron ore, and look at Ford. I don't think we'd see Ford at 18 if, in fact, over the second and third and fourth quarter, we're going to have a downshift in the U.S. economy. I think we're going to do really well and exceed expectations in terms of growth.
Just a few seconds. It's a busy week. Earnings. You've got the Fed. You've got a lot going on. Economic news. What are you going to be focusing on? Just quickly. State of the Union also.
Key is the technical factors. Can we get to 12,000 and stay there? Is the VIX going to stay down? This declining volatility for me is one of the most bullish factors we've seen over the past 2 or 3 months.
Some good metrics to watch. Lincoln, 10 seconds here.
If it was truly bullish, he wouldn't be worried about the technicals.
I was going to say, this is a man who is looking at the big picture. Lincoln, Ellis, recovery at risk.